well. This is going to be the review video for your second test. We're going to start with the statement of cash flows, and the company we're going to be doing the statement of cash flows for is Tennessee Sweet Tea. What I provide you on your test is going to be select information necessary to complete the statement of cash flows. In reality, you would have to go and look at all of your financials, your income statement, your balance sheet, etc. before you prepare this. And it requires a lot of searching through the statements and finding necessary information. For the ease of you guys, I've decided just to put it in one simple place. We're going to be using the indirect method, which means we're going to take the change in accounts from one period to the next. In this case, from Tennessee Sweet Tea's 2017 numbers to their 2018 numbers. We're going to need that for their current assets and their current liabilities, and all of those numbers are listed up here conveniently. And we can see right now the number that we're looking for is the solution to our statement of cash flows. It's going to be equal to whatever cash changed by from the last period to this period. So Tennessee Sweet Tea had $20,000 in cash in 2017's end. Now they have $50,000 in cash at 2018's end. So right when we start, we know that the finale, the end line of our statement of cash flows, is going to have to be a net increase in cash of $30,000. To get there, we're going to have to reconcile our net income to our net cash flows. We're going to do that using all the current assets, current liabilities, and a few other select things. As far as investing, financing, non-cash activities, etc., we're going to use all the information provided at the bottom in bullet points, such as the depreciation expense, the sale of equipment, and the associated loss with that sale of equipment, etc., etc. We're going to use all that information as we work our way through. So let's get started with our statement of cash flows. The first thing that we always have on a statement of cash flows is going to be the company's net income. Again, we're going to set up our net income, and then we're going to adjust that net income so we can figure out our change in cash. So let's start with net income, and we're going to find that in the bullets listed on here. So if we go down to our fifth bullet down, we see that Tennessee Sweet Tea had $10,000 in net income. So let's go and fill that in on our statement of cash flows in the right hand column. 10,000. Now we need to adjust, and the first thing that I have always seen in standard formatting, and I advise you guys to do, is your first adjustment should be your depreciation expense. Again, depreciation lowers income, but it's not a cash expense. So as we are adjusting our net income to our net cash flows, we need to add back in that depreciation because it wasn't physically cash that came out. So let's go to our information and see if we can find a depreciation expense. And it's the very first line. We see we have a depreciation expense of $11,000. So we're going to throw that in here. For this section, you're going to want to put all of these numbers in the left hand column because we're going to have a bunch of adjustments that we're going to total up at the end. Second step that I like is to look for any gains or losses. So let's go to our info sheet. And on our info sheet, we see right here in the second bullet down that they sold equipment. And when they sold this equipment, they experienced, let me fix my typo over here because I'm professional like that, experienced a $1,000 loss on the sale. So we can go to our statement of cash flows, throw it in here. We had a loss on sale of equipment. A loss is going to lower your net income, but the reason that losses happen is because at the point when you sold something, it's different from your own valuation of it, and your valuation is dependent on a ton of different factors, namely what method of depreciation you're using, what your estimate for useful life is, things like that. Valuation is not a concrete, there's an absolute right answer. There's tons of different ways of looking at it. I don't know if any of you ever watched Shark Tank. On Shark Tank, when those people come in trying to seek funding for their company, they always ask them what the valuation of the company is, and they come up with wildly different numbers. It's because valuation is based on purely on estimates, on judgments. They're not raw, hard numbers. So you can't have something in your statement of cash flows that is based upon an estimate. Therefore, it is a non-cash expense. And since a loss lowered our net income, what we're going to have to do is we're going to have to add it back in. Our loss was for $1,000. So we go to our statement of cash flows, and we throw that $1,000 back in. Those are our two items that we usually always start our adjustments for. They're going to be the first two adjustments that you have on your test. After that, you get to move on to the two types of accounts which go under the operating section, which are your current assets and your current liabilities. So we go back to our information page here. Let's start with our current assets. We have cash. We're not going to use this line. The purpose of having cash in there is solely so you know you came to the right answer at the end when you get your net increase of $30,000. We're going to take all of our non-cash current assets, and the first one is accounts receivable. During the last period, we had $10,000 in AR. Now we have $15,000 in AR. Well, let's add this in here. We had an increase in accounts receivable. All things equal, if we did the same exact amount of sales and we have more accounts receivable now than we did during the last period, that means that we must be getting paid less in cash. So an increase to a current asset means you must have somehow either spent cash on it or took in less cash. Regardless of that, what it's going to do is it's going to decrease your cash flow. So we had an increase of $5,000, which means that we're going to put our $5,000 in here. But since it is a decrease, let's make that negative. Our increase in accounts receivable decreased our cash flow by $5,000 because we got paid less in cash. So we're going to do the same thing with the next item that we have on our current assets. And our next item is merchandise inventory. It was $10,000 in the prior period. Now it's up to $20,000, which means we had an increase of 10 grand. So let's go to our statement of cash flows. Increase in merchandise inventory. And our increase in merchandise inventory was for $10,000. Well, if we have $10,000 more in inventory, that means that we must have spent more either purchasing it from our suppliers or producing it. So it's a decrease in our cash flow. We've got one more, and it is supplies. So we had $15,000 in supplies at the end of 2017. It is down to $7,000 now, which means that since we have less, we must have spent less on supplies during this period than we did last period. So that is a current asset going down, and when current assets go down, your cash flow goes up. So we're going to have, in this line right here, a decrease in supplies, and our decrease in supplies was for $8,000, and it's going to increase our cash flow by $8,000. So we're through our current assets, and we get to move on to our current liabilities. From our information, we can see that we have two: accounts payable and accrued liabilities. Things like rent payable, utility payable, interest payable, taxes payable, all of those are considered accrued liabilities. They didn't want to make you go through 17 accounts, so I just gave you one account called accrued liabilities. But let's start with accounts payable. We had $20,000 at the end of 2017. It is down to $12,500 now. It's a $7,500 decrease in accounts payable. Accounts payable are things that you owe people. So again, all things equal, if we did the same amount of business and our accounts payable decreased, we must have been paying off more of our debt in cash, and therefore that decrease in our current liability is going to decrease our cash flow. Current liabilities always work the same way as cash flow. So let's add in our decrease in accounts payable, which was for $7,500, and since it is a decrease to cash flow, we're going to put it in negative, and we're going to come up with negative $7,500. Our last one that we have is our accrued liabilities, and as we saw a second ago, and I'll go back, our accrued liabilities decreased. So we have a decrease in accrued liabilities. Well, if we go to our information, we see that our accrued liabilities decreased from $25,000 to $12,500. So that is a $12,500 difference. That's the amount of our decrease. We're going to throw that in here, and we come up with negative $12,500. Since this is the last of our current accounts, our last of our adjustments, if you will, what we're going to do over here is we're going to find the subtotal of it. So we equal sum, open a parenthesis, select the whole entire range of cell B7 to B13 where all of our adjustments are, close the parenthesis, and we hit enter. We come up with a total amount of adjustments of a decrease of $15,000. So our net cash from operating activities is equal to our net income plus our total amount of adjustments. We had from operating activities a decrease in cash of $5,000. We're through the first section. We can move on to the investing section. And the investing section deals pretty much purely with long-term assets, things that you plan on having for more than a year. So we go to our list of bullet points here and we see what we have. Well, right here we had a cash sale of equipment. That is a long-term asset. So we know that the cash sale part, the $21,000, has to go in that section. We already took care of the loss of $1,000 during our adjustments. So our cash sale of equipment, $21,000, is going to go into our investing section. Look through our other things. We have a cash receipt for common stock. Common stock does not go in investing because it's not a long-term asset, nor does dividends. Net income we already took care of. We have a cash receipt from the issuance of bonds payable. Bonds payable, long-term debt. It goes in financing, not investing, so that one's not going to go in there. We have the acquisition of a piece of land by issuing $10,000 of common stock. And you see land and you say that's a long-term asset. But how are we getting that long-term asset? We are getting it by issuing common stock. We're not paying the $10,000 for that piece of land. We're instead giving the company $10,000 in common stock that we're purchasing the land from. Which means that that transaction, no cash changes hands. And that's going to be a non-cash transaction. Since it's non-cash, we don't put it into our regular investing section. We're going to wait on that till we get to the non-cash section. The next one we have is a $6,000 cash payment for the purchase of furniture. Bingo. Furniture is a long-term asset, and we are acquiring it by paying out cash. So we know that cash payment for furniture is going to go into our investing section. And our last bullet, the settlement of a $25,000 mortgage payable by issuing $25,000 of preferred stock. Well, first things first, mortgage payable is a long-term liability. It is not a long-term asset, so it would go into financing section. And even furthermore, we're not paying off that mortgage in cash. We're paying it off by trading something else, in this case preferred stock. So just like this entry up here, the one where we got land for common stock, paying off our mortgage by issuing preferred stock, no cash changes hands. It is also a non-cash transaction. So the only two things that we have that are going to go into the investing section, the only two transactions we had dealing with long-term assets where cash actually changed hands, is our sale of equipment and our purchase of the furniture. So let's go to our statement of cash flows. We're going to call this a cash receipt for sale of equipment. And you can use that exact phrase if you want to. I would be totally fine with you guys just saying equipment sale. That's fine for me as long as you have the gist of what's happening. So when we sold this equipment, we sold it for, one more time, $21,000 right up here. We're going to throw that into our left column on our way to a total. Since we are selling the equipment, we're the ones receiving cash, and our cash flow has to go up. So the sale of any long-term asset is going to increase our cash flows from investing activities. The other thing that we had was the purchase of furniture. So I'm going to call this cash payment for purchase of furniture. Again, if you want to just call it furniture purchase, that's fine with me. We paid $6,000 for that furniture. We paid in cash. Well, if we paid in cash, that means that our cash flows from investing activities has to be going down since we're the ones sending cash out. Since those are our only two transactions, our subtotal is going to simply be equal to our cash receipt from the sale of equipment plus our cash payment for the purchase of furniture. And we get a subtotal of $15,000. Put a space in there. So now we have to find out our net cash provided by operating activities, and that is simply going to be equal to this same subtotal. Now we're on to our cash flows from financing activities. Actually, back this up. You don't need this one right here. We'll instead do this here. I apologize. Now on to our financing activities. We're going to have, to start with, anything that has to deal with long-term liabilities or equity issuance. So as we go through our list, we have a cash receipt from the issuance of common stock. That for sure is going to go on there. It's equity. Payment of cash dividends. That is a cost associated with equity, so that has to go in there. And we have a cash receipt from the issuance of bonds payable. Again, that has to be part of the equation as well. What we're not going to put in there, even though it says stock, are the acquisition of land for common stock and the payment of a mortgage for preferred stock, because those are non-cash transactions. No cash change hands. We're only going to put in the transactions where cash actually, either came into our business or came out of Tennessee Sweet Tea's business. So let's start here. We have the cash receipt for the issuance of common stock. Let's start with that number. And our cash receipt for the issuance of common stock was for, we see right here, $25,000. Since we are the ones issuing the stock and therefore taking in the money, we're going to put that in as a positive number. We had the cash payment of dividends, and the cash payment of dividends was for a total equaling $15,000. Since we're paying the dividends out of the company, it's going to decrease our cash flow from financing activities, so we'll put that in negative. And then the next thing that we have is our cash receipt from the issuance of bonds payable. And the column's not wide enough, so let's just make that bigger. If you ever find this scenario, go up to the top where you get this little black line like that, and you can slide it over till it's the right size. There we go. So we signed a bonds payable, and when we signed that bonds payable, it was $10,000. So we're the ones taking in the cash by selling the bonds. It's going to be positive. And our net cash provided by financing activities is going to be equal to the sum of those three numbers, or $20,000. So now we have our net increase or decrease in cash. What we're going to do here is we're going to have equals, and we're going to make this equal to the three different categories that we have. The first one being operating, so I click on this negative $5,000, plus our investing activities, plus our financing activities. So it's only the three main categories. Don't add in your net income or the subtotal of your adjustments. That's a thing I see commonly, is people just totaling up the second column. It's not. It's just the net cash either used or provided by your three main type of activities. And that will give you your net increase or decrease in cash. And when we enter, we see that our net increase in cash is $30,000, and we're very happy about this, because when we go back to our information, we see that cash did in fact increase from $20,000 to $50,000, which is an increase of 30 grand. Underneath, we have our cash balance on the last date of the prior year. Well, we can just go to our info, click that cell of what it was, which was $20,000, and hit enter, and that'll bring us our cash balance there. And for the end of the current year, again, we can just go to our info, click on the amount of cash that we had, and hit enter, $50,000. So we know that our statement of cash flows is good, because our net increase in cash, according to our statement of cash flows, is absolutely the same increase in cash that we had on our comparative balance sheet. Last step that we have to do is take care of our non-cash activities. And from our information, we already determined there was two. One of them, we acquired land by issuing common stock, and in the second one, we settled a mortgage by issuing preferred stock. Let's go find the sum of those two numbers, and that was going to be for the acquisition of land by issuing common stock, it was for $10,000, and for the mortgage, getting rid of that for preferred stock, it was $25,000. No one has ever properly explained to me why this is, but for the non-cash section, they're typically only going to go into the right-hand column. Again, it's formatting. I'm not going to take off points if you subtotal like the others, but it's not the way it's typically presented. I wish I could give you a better reason. I simply don't know why it became standard to be that way, but that's the way that it is. Which means that our total non-cash activities are $35,000. And with that, we are done with Tennessee Sweet Tea Statement of Cash Flows for the year ended December 31st, 2018. It's half of your test. The other half of your test is your financial statement analysis using vertical analysis, horizontal analysis, common size, and ratio analysis. So in the next video, I'm going to cover all of those. Take care, everyone.